Hello, this is Craig Mitchell, your personal mortgage consultant for life. And this video that you're going to watch today is an excerpt from one of my first-time homebuyer seminars. So if you're a first-time homebuyer, this is information you definitely need to know. And even if you're not a first-time homebuyer, I can almost guarantee that most of the information will be new to you, so you can definitely benefit by watching it. If you do have any questions or comments after watching the video, please email me or call me, and my contact information will be provided at the end of the video. Okay, so next we're going to cover interest rates and why interest rates are expected to skyrocket over the next few years and what that means to you. So first we're going to cover three things. 1, how interest rates are determined. 2, what causes interest rates to go up and down. And 3, why interest rates are expected to skyrocket and what exactly that means to you. So first of all, how are interest rates determined? When you get a home loan, your bank is going to sell your loan to a company named Fannie Mae. You might have heard about Fannie Mae on the news because in 2008 they virtually went bankrupt and had to be bailed out by the federal government. Fannie Mae is a quasi-government agency whose sole purpose is to buy home loans from banks so that banks can turn around and lend that money back out again. If the banks didn't sell their loans, eventually they would simply run out of money. So here's how it works. You go to your bank or mortgage company and get a loan for, let's say, $100,000. Well, your bank then turns around and sells that $100,000 loan to Fannie Mae for $103,000, which means your bank makes a $3,000 profit on the loan. So the bank is not actually making money on the interest on your loan. They make their money by selling your loan for a profit. Then they take that same money, do another loan, and sell it again for a profit. And they might do this 4 to 6 times per year with the exact same money. The banks do this for 2 reasons. 1, if they didn't sell their loans, they would run out of money. Banks do have a lot of money, but it's not unlimited. Number 2, they make a lot more money by selling your loan than they would by keeping it. When your bank sells your loan, they will send you a letter telling you that your loan is being sold to Fannie Mae. However, your mortgage payment will still go to the bank you started with because Fannie Mae does not collect payments. So if your lender is Wells Fargo, for example, they would sell your loan to Fannie Mae, but your monthly payments will continue to go to Wells Fargo, and then Wells Fargo just forwards that money on to Fannie Mae. And since all banks sell their loans to Fannie Mae, who do you think determines what your interest rate's going to be? Exactly, Fannie Mae does. So the banks don't really care if interest rates are 4% or 10% because they make the same amount of money either way when they sell the loan to Fannie Mae. Now if you go to 5 different banks, their interest rates may vary slightly, but they're all going to be fairly close to each other. And the reason their interest rates vary slightly is because they might have different or slightly different contracts with Fannie Mae. So to summarize, your interest rate is determined by Fannie Mae, not by the banks. So the next thing we're going to cover is why interest rates go up and down. Why are interest rates 4% one day, then 5% a week later, then a year later they're all the way up to 7%, and then back down to 5% again a few months later? Well, as I mentioned before, Fannie Mae tells the banks what interest rates to give you. So to figure out why Fannie Mae is always raising and lowering their interest rates, we have to figure out where is Fannie Mae getting all of their money. Fannie Mae owns over $5 trillion worth of mortgages. That's trillions with a T, and that's a ton of money. Just to give you an idea of how much money that is, if the state of California had $5 trillion, that would run the entire California budget for almost 50 years. So where does Fannie Mae get all of their money? Fannie Mae is a government/private company, and to raise money, they sell what are called bonds. And a bond is similar to a CD that you would get at your bank, where you invest money and you get a guaranteed rate of return on your money. At the bank, a CD is FDIC insured, so if the bank were to go out of business, the FDIC would step in and reimburse you for any money that's lost. So CDs are very, very safe, but you also don't make a whole lot of money on them. Well, a bond is just like a CD. You could go to Fannie Mae and buy a bond from them, which is where you invest your money, and they give you a guaranteed specific rate of return just like a CD. The only difference is the banks have the FDIC to back them up, and Fannie Mae has the United States real estate market backing them up. So really, the only way you could lose money with Fannie Mae is if the real estate market were to take a nosedive. And this is precisely what happened in 2006, is the real estate market took a nosedive, and that's why the US government stepped in to bail out Fannie Mae, is because they were getting ready to go out of business. So this brings us back to our last question. Why is Fannie Mae always raising and lowering their interest rates? Well, Fannie Mae technically does not control their own interest rates. The interest rates are determined by the investors that invest in their bonds. So for example, if China, the country, decides to buy $100 billion in bonds from Fannie Mae, and China wants an interest rate of 8% for their money, well then Fannie Mae has to pass that on to you. If Fannie Mae is paying 8% to China for that money, then they would obviously have to charge you more than 8% to make a profit. And so that's why interest rates are always going up and down, is because investors who supply the money to Fannie Mae are always raising and lowering the interest rate they're looking to get from their investment. If things are getting a little confusing right now, just hold on for a few more minutes, because once I cover this last section, everything's going to fit together and make a little more sense. So finally, we're going to cover why are interest rates expected to skyrocket over the next few years, and what does that mean to you? Well, as we just covered, the investors that supply the money to Fannie Mae are really the ones who control what interest rate you get on your loan. So the question is, how do the investors determine what interest rate they want to get on their money? Typically, the investors that invest in Fannie Mae want to get a 2 to 3% return on their money above inflation. So what exactly does that mean? Well, in case you don't know what inflation is, let me give you a brief explanation. Inflation measures how much the cost of living is going up here in the United States on a yearly basis. So if inflation is 2%, that means the average cost of living is 2% higher this year than last year. So on average, the cost of bread, milk, gas, clothes, and everything else went up on average 2%. Well, if investors want to get a 3% return on their money, then really they need to get a 5% return, because 2% of that is going to get eaten up in inflation. So for the most part, that's how investors determine what rate they want, is by basing it on what current inflation is at. As inflation goes up and down, interest rates also go up and down following inflation. So that brings us back to the third topic. Why are interest rates expected to skyrocket over the next few years, and what does that mean to you? Well, as we just covered, interest rates on home loans are directly tied to inflation. So if interest rates are expected to skyrocket over the next few years, that would mean the experts are expecting inflation to skyrocket over the next few years, which would cause interest rates to also skyrocket. So the last thing we have to figure out to put this puzzle together is what causes inflation. Well, what causes inflation is when the Federal Reserve and the United States government decide to spend more money than they collect in taxes. When the United States government spends more money than they have in taxes, that basically means that they're pumping more money into our economy that never before existed. They're basically printing more money. And when the government overspends $500 billion a year, it's like pouring water into milk to make more milk. They're diluting the value of our money and making it less valuable. And in case you haven't been watching the news over the past few years, the government is overspending like crazy, and most experts agree that inflation is going to skyrocket in the next few years, which means we're going to see mortgage rates also skyrocket. So what does this mean to you? Well, basically, the lower your interest rate, the more expensive house you can buy for your money. So for example, if you can qualify to buy a $200,000 house with a 6% interest rate, well, if rates go up to 8%, then you would only be able to qualify to buy a $170,000 house, but your mortgage payment would be the same. And from what all the experts are saying, we could see interest rates go up by a couple percent over the next 12 to 24 months. So what it boils down to is, if you're thinking about buying a home, you're going to get more for your money now than you will a year or two from now. So if you're on the fence, get off the fence, call your realtor, and start shopping for a house now while interest rates are still low. I know this has been a long video. I hope you found it useful, and I look forward to seeing you next time.